Steinhoff out with results today. The group's reported a 6% fall in revenue to 48 billion rand. Headline earnings rose 9% to 3.5 billion rand. Headline earnings a share were just 1% higher though. The group's raised its dividend by 5% to 63 cents a share. With more on the numbers, we're joined from our Cape Town studio by Janine van Zyl. She's Sector Head of Industrials at Omixa. Janine, thanks for joining us this evening. The results look reasonable given the environment Steinhoff's been operating. And what's your view though?
Yes, I think they are. They're in fact ahead of the consensus view, which expected a 5% down in earnings. And I think when we do strip out a lot of the currency effects, which the company did for us, we actually see that the results were a lot better. You know, they sit with the same problem that Shoprite and Massmart have, is that they're translating businesses that are trading in other countries. And with the rand so strong, those businesses look terrible if you bring them into rands. But actually, their revenues would have been up 3% and their profits up 15% if it was at constant currency.
Of course, you talk about the strong rand because a significant amount of its manufacturing and sales now take place in Europe. In fact, over half of its revenue comes from Europe at this stage. So this is a company that's really growing in the European market quite fast.
Yes, I think that has been their strategy over the last 6 or 7 years. It's been a very interesting strategy, came with a lot of skepticism from the investment market, but it has been very good. They've really taken that whole European furniture market and are consolidating it slowly. It was previously a very deconsolidated market, and they're doing very well at that.
Of course, over half of its revenue comes from retail activities, including household goods, building supplies, automotive. And those are all sectors that I would have thought would have done fairly badly in a downturn. Why do you think that Steinhoff's managed to get it right in that environment?
Well, if we're looking specifically at the areas that they trade in, firstly, the retail of furniture sales in Germany. Germany is the one part of Europe that has actually survived this crisis quite well. And we have seen also in the last few months that their retail sales have started turning positive. So we're seeing the same in the Steinhoff results. When we move over to the retail in the UK, maybe one wouldn't have expected quite a stronger result given that retail sales there are still very flat and haven't yet turned the corner into positive territory. But they are trading in an environment where two large competitors, MFS and the Land of Leather, both went under during the crisis. And now what's happening is that the remaining competitors, being IKEA themselves and MFS, are really mopping up what's left. And as a result, their sales can grow and their margins too.
How about Southern Africa though, because that still makes up about 43% of revenue. Revenue in the region up by about 6%. So are we also seeing resilience in this market here?
Well, there we're really seeing, they've got 4 different businesses there, or four largish businesses. We're seeing 2 of the businesses do really well, and that's the automotive retail. We have seen car sales rebound quite a lot, and they've benefited from that. And then also Unitrans, which is the logistics business, they've benefited very well there from picking up some large contracts in specific sectors. So we're looking at sugar, agriculture, mining, and they've done very well at that. I think partly they've benefited from the fallout of Supergroup a year or 2 ago and picked up some of those large contracts. But then the 2 other businesses that haven't done as well and have lost sales and margins are Penny Pinchers and PG Bison, and both of those are focused more in the construction, and we really haven't seen home sales, home construction rebound yet, and they are suffering, and their sales are still down and their margins in those areas.
Of course, Steinhoff says in the commentary that its integrated business model is a key competitive advantage for it, which makes sense to me because it makes goods, it transports them on the logistics chain, and then it sells the stuff. How do you view this integrated model?
Yes, I think they've been very successful at that, and funnily enough, in this particular result, you really notice how successful it has been. They, particularly with regard to their manufacturing in Poland, supplying into Germany, they have actually pushed more of their buying into Poland because the currencies just meant that it was quite difficult getting product cheaply out of China, given the currency, the euro Chinese, the euro 1 rate. So they actually pushed or bought more from their Polish manufacturing, and in a period like that when you would think maybe volumes were down in manufacturing, they then managed to push up their volumes. So it really has played well into their hands. As a long-term strategy, it also makes a lot of sense. They are one of the biggest distributors into Europe, and they have very large warehouses that do it, and I think they've done a very good job at that.
How about Australia though, because that looks like one market where it hasn't been quite as successful, but we've seen quite a number of groups, South African groups as well, under pressure in Australia. What's happening down under?
Yes, the problem with Australia is, well, firstly, they've had 5 interest rate hikes. They had it long before the rest of the world started hiking. Well, the rest of the world hasn't started hiking. And then also last year they had some very large government grants that all citizens got. And what really happened is at that time, citizens spent that, it went into the retail trade, and I don't think that even the Australian government realised how much that was stimulating the retail market. And now what we're seeing is it's coming back to bite us, because we're now, the companies that trade there are trading off very high bases of last year. We saw Woolworths up against a high base, and all the competitors in the retail industry actually showing slower retail sales. So I don't think that they're out of line here, but it is a very tough market to be trading in Australia right now.
Janine, we have to leave it there. Thank you very much for your time this evening. That's Janine Finzel, the Sector Head of Industrials at Amixa. Well, we're joined now by tonight's Market Watcher, and that is Simon Filmore from Independent Securities. Simon, your view on those Steinhoff numbers that came out today?
Yeah, I think they were actually a lot better than what most people were expecting. I think in this sort of environment to come out with flat earnings when your major market is the retail market is quite commendable. But if one drills behind the results, I think they were given a little bit of a boost in their earnings from their corporate services, where they make money from treasury services, property management. So that did boost the headline earnings number just a little bit. In terms of the divisions, the automotive division performed particularly well, and they took a little bit of pain in their manufacturing and retail businesses.
How about going forward from here though, Simon, because we know all the austerity measures that they're implementing in Europe. Germany, one of those countries implementing austerity measures, and that was one of the strong sales areas for Steinhoff. So, I mean, do you think it's probably quite a murky picture for Steinhoff going into the new year?
Steinhoff has been a difficult business to analyse over many years, and when you think it will when you think it'll perform badly, it does opposite. You think the currency is going to affect it because there are a myriad of variables that can affect its income. But it's quite remarkably built up quite a solid and very unvolatile stream of earnings over the year. So it does seem its integrated business model that we were chatting about earlier on does seem to have a buffer in that. Going forward, one could argue that consumers are fairly indebted in developing in developed countries, where the majority.
In developing countries, everywhere.
Yeah,
except China.
Yeah, and that would quell their sales growth to some degree. But that's probably more than priced in at the share. It's probably on a PE of about 7.7. And one of the things that has historically worried us about the share is that it would make massive acquisitions. The gearing of the business would scream close to anything between 50 and 100%, and one would kind of hold their breath. You'd hold your breath and wait for the returns to come in. And so it has meant that free cash flow in the business has been lumpy over the years. But from an earnings perspective, it's got a pretty solid track record behind it.
Mm-hmm. The debt to equity at the moment, we're sitting around 34%, so that's obviously come down a little bit. And it also talked about a 45% increase in net cash flow from operations. Does that comfort you a little bit?
It does, but I think
until they make the next big acquisition.
Yeah, then we'll see that quickly go south again. But I think we look at their revenue line that contracted, so by definition they should have a very strong working capital performance when your turnover declines. So that wasn't too surprising, and it can be volatile from one year to the next.
Metroex also out with numbers today. Headline earnings per share 25.2 cents, and that's up from 23.9 cents a year ago. And so it also looks like a bit of a turnaround at Metroex.
Yeah, extreme turnaround, and once again quite a complicated set of results. And Metroex have probably got a history of making exceptional items look normal, because they're a lot of once-off or non-recurring things in those results. But I think the key metric that one needs to look for in Metroex is their production and what's happening with that. And it's likely that they'll get to design capacity of about 60,000 tons of copper over the next 12 months or so, and over the next 2 to 3 years, that'll probably, if their development and exploration goes according to plan, it could approach 100,000 tons. So I think the business is looking good. A very low base, so it doesn't really mean anything. But the share is trading probably at a little discount to NAV at the moment.
Is that justified?
Yeah, Yeah, I think the biggest risk with Metroex is that they have production problems, and of course they operate in Central Africa, in the DRC and Zambia, and the political risk in those countries is high. But I think if one clears through all the murkiness of their results, the business is capable of achieving earnings of probably 70 cents a share, putting it on a mid-single-digit PE. So it looks fairly attractive from that basis. And I think also another key aspect of the results was that it was locked into quite punitive hedges following its debt restructuring a couple of years ago, and the amount of copper that they have to sell into these hedges is reducing quite significantly, and at this stage they were selling into copper prices in terms of those hedges at $3,900, and we see the price now trading at $7,500. So there will be some upside from that going forward as well.